Welcome to the Long-Term Investor. I'm thrilled today to be joined by Ann Sonders, Chief Investment Strategist at Charles Schwab. Ann, thank you so much for joining me here today.
Oh, it's a pleasure to be here, Peter. Thanks so much for having me.
If you had told me when I started this podcast that someone like you would eventually be a guest, I'm not sure I would have believed you. But here we are. And if you're watching us on YouTube or watching us on Cheddar News, Ann, we're going to have a big intro on the podcast for her. But as Chief Investment Strategist, I'm kind of curious if we can start there. Just tell us, to you, what does that even mean? What is your role there?
Peter, it's a funny question because it makes me think of, and this is many years ago now, I got asked to be part of career day at my daughter's middle school. Now, she'll be 26 in a week, so that's how long ago this was. But it was a cool event where they had parents come in, and you, as a parent, you stayed in one classroom and the kids rotated. They picked, 3 or 4 careers that they wanted to hear about. But I remember the prep call with the principal and their suggestion that we figure out how to explain what we do if it's a complicated thing, like something other than, say, a police officer, in a manner that middle schoolers could understand. So I thought, boy, how do I do that? And so I remember saying, well, kids, I read, write, and talk for a living. That's the basics of the day to day. Maybe up a level of sophistication in terms of the answer. I sometimes jokingly say I'm the chief pontificator, but I think the best way to describe it is I'm an interpreter of what's going on both in the economy and the market, and try to distill that interpretation in a way that is beneficial to our individual investor audience base, which I mention that specifically because we are not a traditional Wall Street firm in having institutional clients, hedge funds and money managers and mutual funds. So I think the audience and the need for information, how they use that information is very different than, say, what the audience is for a strategist at a Goldman Sachs or a Morgan Stanley. So it's all geared toward the individual investor in helping provide guidance and helping them understand the interplay between what goes on in the market, what goes on in the economy, and providing that perspective without trying to do short-term market timing.
Well, that all resonates with me, having read your work for nearly 2 decades now. I first latched on to your words during the financial crisis, and you were one of the people who it seemed like was focusing not just on the craziness, but just trying to find like the bright side of things, not necessarily in a head in the sand, everything's going to be great, but like you just mentioned, with some perspective. And your 2026 outlook is out. We will certainly talk about that. But a lot of people in your role, I think, get associated with forecasts. And there really isn't anything in your outlook that has forecasts. So I guess from your perspective, when you put an outlook out, is that a fair assessment? You're not making forecasts. Like, what role do you hope that that outlook provides individual investors or even the advisors who are reading it?
So maybe I'll answer it in the context of why we don't do year-end price targets, which is probably the most common exercise done by strategists, certainly traditional Wall Street strategists. And there's lots of facets to why we don't do that. And I will never forget the very first conversation I had about taking on this role, which prior to me, 26 years ago, the role didn't exist at Schwab. And it was a conversation I had directly with Chuck Schwab himself. And he was talking to me about the desire to create the role and would it be something I was interested in, which of course I said yes. And 26 years later, I'm still here, and it's only for all intents and purposes, only my second job. I managed money for the first 13, 14 years in the business. And he specifically mentioned a desire not to fall into that kind of what we would almost think of as a trap of year-end price targets. And I think it's because it sort of pretends precision where there isn't precision. And by the way, the industry knows this. It's also, and by the way, I'm so glad you asked this question because part of the reason I'm looking off is I'm writing a kind of an evergreen piece as we speak. I'm not sure when it will publish on exactly this subject. the perils of forecasting, why we don't do year-end price targets. So I'm trying to remember some of the things that I had jotted down. Markets don't move toward a destination. They traverse a path of constant uncertainty. And that's why I always chuckle at that old line of the market hates uncertainty. It's always uncertain. I've never woken up to the front page of the Wall Street Journal. It says, we know everything. Everything is certain. So I think a single year, end of year number, moment in time, 4 p.m. on whatever the last day of the year is, the volatility that happens along the way, the interim drawdowns that happen along the way, the rotations and the churn under the surface, different regimes that pop up. And I think it's perspective along the way in helping guide investors as things are happening makes so much more sense than trying to forecast what the market is going to do, especially some moment in time tied to the calendar. Frankly, and I use this as an example, I started in the business in 1986, so I was around in 1987. If a strategist had said at the beginning of 1987, they had put a price target that was like a percent change from what the starting point was, but didn't provide perspective along the way, at the end of the year, they could have said, I nailed it. I nailed because the market was actually flattish in 87. Needless to say, what happened along the way was as dramatic as it comes. And so I just think it's kind of such a false precision that I think it's more about a way, I think, for the institutional world to sort of pit strategists against one another, who was right, who was wrong. I just don't think it's great advice for investors. Trying to time the market is an impossible thing to do, and therefore we don't try. I think the misperception is that that is the key to success, sort of the get in, get out, try to pick tops and bottoms. I don't know any successful investor that became successful taking that kind of approach, and that's why we don't do it.
Yeah, I'm with you. I mean, I think the investor's job is not to beat the market. You're saving every dollar you earn can't be saved, and every dollar you save can't be invested. But for those dollars you're investing, I continually say on this show that you're just trying to outpace inflation without taking undue risk.
Exactly.
And hearing about your background, it's really difficult for me to resist pulling on the thread because I know you worked with Marty Zweig and I know about, the call that was made ahead of the crash in 1987. But maybe if we get enough time at the end, I will circle back there.
And even if we don't, by the way, you can find it on YouTube. It's fascinating. Okay. So just look up October 16th, 1987, Marty Zweig, Wall Street Week, and watch it. It is extraordinary because he was a rare person that did have pretty decent success market timing, and it was surreal.
Well, and so for all of you listening, or if you're watching on YouTube or Cheddar News, I will also link to that at the longterminvestor.com. It is, Liz Ann really does have, she mentions only having 2 jobs effectively, but the first one was really quite phenomenal. If we had more than an hour, we might go down that path. But I promised the listeners we would talk a little bit about outlooks. And before we get there, I'm just kind of curious because we're not forecasting the future here. Tell me a little bit about what your process looks like as you're developing a 2026 or any given year's outlook.
Yeah, well, again, a lot of it is the melding of what's going on in the economy and what's going on in the market, and trying to assess whether, say, the economic cycle has some reference to history, might be considered a normal economic cycle, and if so, where are we likely to sit in that cycle? Certainly in the recent 5-6 years or so, understanding the unique aspects of this cycle and kind of the post-COVID environment, and trying to explain maybe the differences in how this cycle is unfolding, and that we shouldn't think of it in linear fashion, that it's not, early cycle, mid cycle, late cycle, boom, recession comes. There's so many nuances to understanding economic cycles and then the application into what the market environment is. I do tend to think my framework, I would say, and just the way my brain works. There's other firms that do this. Hedgeye, I know Keith McCullough very well. I do his summits quite often. GavCal is a firm we get really great research from, and we do some research sharing with them. kind of that quadrant framework where you think of the big drivers that are economic drivers, but that have direct influence on the market. So the direction of inflation, up or down, high or low, the implications that that has for monetary policy. Are we in an easier cycle, a tighter cycle? Are we transitioning between one and another? Marty Zweig he coined the phrase "Don't fight the Fed." So I grew up in this business, learning that part of it, understanding investor sentiment. That he used to call that the investor liquidity component, understanding the relationship between investor sentiment and consumer sentiment and the interaction between those two. Looking at the trajectory of earnings and understanding the valuation backdrop, keeping in mind that, as we always like to remind investors, valuation is a terrible market timing tool. Now, we already discussed the fact that I don't think there really is some foolproof tool for market timing. It's an impossible or nearly impossible thing to do, notwithstanding October 16th, 1987 with Marty Zweig, because valuation is almost an indicator of sentiment. Valuations can get stretched and get more stretched and even more ridiculously stretched, and it doesn't represent some timing tool, but understanding the interplay, and understanding, okay, if we're in an environment where valuations are seemingly rich, what does the earnings backdrop look like? And maybe one of the most important things I do, and I try to impart this to investors when I talk about both my process, but where we might be in a cycle. I'm a big believer, and I've been saying this for my 40 years doing this. Better or worse often matters more than good or bad, especially as it relates to the connectivity between what's going on in the economy and what's going on in the market. It's human nature for us to think, was the data, a jobs report, a retail sales report, a GDP report, whatever it is, or earnings, was it good or was it bad? Was it strong or was it weak? But better or worse is the determinant more often than not of what the market does. And that's why it really confounds investors at times, especially if you're kind of flying high in the economy. And more often than not, if you're going into a bear market, that comes first before you start to see the obvious signs in the economy. And that has to do with the market's uncanny ability to sort of sniff out inflection points. But you think about inflection points when the data stops getting better and starts getting worse. At that snapshot in time, you're at the apex, you're at the peak. So in absolute terms, in level terms, the data still looks fantastic. Conversely, when you're at the bottom and the economic data stops getting worse and just starts to get better, the market tends to sniff out that inflection point. But at a snapshot in time, you're at the bottom. Without knowing that you're about to improve, the data looks absolutely horrific. So if you just look at when bear markets have started, when bear markets have ended, and then look at that moment, especially pre-revision, what the data looks like, it's not very supportive. Those dots don't seem to be connected. And that's what I try to figure out with any outlook. How are those dots connecting? Where are we in the cycle? And how to think about market behavior based on that.
So many things you've said that I feel like I'm going to be able to tie back to later. Why don't we talk a little bit about 2025? Like, what has happened? Where are we? Where is sentiment today? I feel obliged to point out something that I've heard you say a number of times, as others, but basically that tops are a process, but bottoms happen pretty quickly.
Yeah.
Where are we in 2025? Well, I guess with 2025
2026 now.
Yeah, right.
I think that I don't want to say I hate being in the consensus. That's not the truth. I'm never a contrarian just to be a contrarian, but sometimes I feel like, really, everybody has this view and so do I. And that view is that this broadening out trade that we have already started to see, it kicked in the latter part of last year. I think that has legs. That is the consensus, though. Again, that doesn't mean I'm going to move away from that view simply because so many other people have that view. But I do think the sort of inner workings of the market in a year like this are going to look a bit different than last year. Certainly the first, maybe call it 2/3 of last year, where you had that mega cap bias, you had severe concentration, you had a very low percentage of stocks within an index like the S&P 500 outperforming the index itself. But you had such dominance, again, at least in the first half to two-thirds of the year, by the mega cap stocks in a cap-weighted index. It kept, the market looking like it was fine. But the fuller, more complete story was told under the surface. So in a year like last year, where the S&P was up 16%, the average member of it's actually 502 constituents in the S&P because two stocks have two shares. It's actually
Google and
504,
Berkshire.
right?
Yeah.
But let's
For
just call it
Alphabet, sure.
500
Yeah,
for
yeah.
simplicity's sake. The average member in calendar year 25 had a maximum drawdown of 27%. Within the NASDAQ, the average member in calendar year 2025, in an environment where the NASDAQ was up 20% at the index level, the average member had a maximum drawdown of 52%.
Wow.
It just happened through a process of rotation and churn under the surface. You had the indexes kept more than just afloat by virtue of the power of those mega cap names. Another lesson that comes in an environment like that, and I think this is an important shift that has started to happen in the latter part of 2025, and I think will persist into 2026, is that it really highlights the difference between a stock's contribution to index returns and a stock's price performance. So I always use an example of this, which is NVIDIA, kind of the poster child for everything AI and the poster child and, always the first stock we think of in the so-called Magnificent Seven. And last year, the NVIDIA was the number one contributor to S&P 500 returns, but it was the 75th ranked stock in terms of price performance. So it was the largest contributor because of the size. So contribution to capitalization weighted index returns comes from price performance multiplied by the capitalization size. In other words, 74 stocks within the S&P 500 outperformed NVIDIA, even though it was the largest contributor. And the reason why I always bring this up is because I think that there's this misperception. First of all, I think there's a conflating of contribution and price performance. I still hear people, the only way I can do well is to only own those names because they're the best performers. They're among the biggest contributors. They're not the best performers. And you don't have to take that concentration and bring it into your own portfolio and the risk associated with that, because individual investors are not institutions. If you're a fund manager and you're benchmarked against the S&P 500 on a quarterly basis, you are at the mercy of the construction of the indexes. You have to have some semblance of similar size or you're going to underperform the index. But that's not an individual investor problem. But now we have a situation where last year, only two of the Magnificent Seven outperformed the S&P 500. You actually went old school. Two of the best performing stocks in the S&P were SanDisk and Western Digital, not brand new, hyped up AI related names. And I don't cover individual stocks. None of this. I mention names, but they're not recommendations one way or another. It's just to kind of make the point that I think there's now going to be more opportunity that has presented itself, in part because the average member within the S&P had a 27% drawdown at some point last year. I think that bred opportunity. It bred an appetite for where else can we find interesting ideas. And I think that's a theme that started in the latter part of last year, and I think will continue in 2026. It's a more level playing field for active managers relative to passive. It's a more level playing field for equal weight relative to cap weight. Not in a linear fashion, but I think it's going to be a more interesting year, maybe a year with more opportunity for investors to find interesting ideas outside of just these monolithic small little cohorts.
Well, I really appreciate that perspective. There's a chart that I often show people about what the performance of the top 10 largest S&P 500 stocks are up until the point they become top 10, and then what happens to the performance after they've made the top 10. And people just can't wrap their heads around how can that be that they really underperform on average the following 5 or 10 years. And
Law of
it
large
is,
numbers.
yeah, no, absolutely. And I think in general, as you started the comment with saying like the broadening of performance, so that might mean to an investor who's more diversified in the mid cap space or the small cap space or value. And I suppose you aren't really meaning, I was going to say international emerging markets obviously did really well in 2025. As you mentioned, valuations are not a great timing tool, but they can act as a compass for any investors out there. And much of what your work does and the other work that I like to put in front of individual investors is, again, creating that perspective. In many ways, I'll admit that I just want to tell the story that gets somebody to stay the course. But in general, I do think it's a really interesting trend, but also exciting just for anyone who is the diversified investor and who has felt like they've lost out the past decade plus. One quick quote I want to read from your 2026 outlook that you already kind of said something like this at the start when you're talking about your process, but I really liked it. Quote, uncertainty generally assumes unknowns, elections, wars, Federal Reserve decisions, etc. Stability stems from the inner workings of the system itself. And there's a large list of bullet points: tariffs, housing supply, labor supply, fiscal, all these things. When you're looking to 2026, you've mentioned a few things like the trajectory of earnings, sentiment, valuation, backdrop. What are you most focused on? Or maybe what's the thing that could have you shift your view fastest if it changes today?
So the outlook for earnings, which is the mother's milk of stock prices, it's obviously an important fundamental driver, not in lockstep by any means, but there are still healthy expectations for earnings growth and for profit margins to remain in very healthy territory. That would be an obvious problem, I think, if we were to find that now actually the bar has just been set too high. The opposite has been the story of the last couple of years, very much so in calendar year 2025, where by the time all was said and done, and we only have 3 quarters worth of actual earnings data because we won't get fourth quarter until another couple of weeks from now. When all was said and done in each of those 3 quarters, actual earnings had bested what the estimates were at the start of earnings season by about double. I'm not suggesting my base case is that the bar has been set too high, but I think that would represent a risk. I think an inflation problem really developing again, escalating, such that it put the Fed not only in a position to have to stop considering continuation of easier monetary policy, but actually potentially move to tightening policy. So, again, none of these are my base case, but I'm also paid to assess risks and what could cause problems in the market. And those would be two top of mind. Notice I didn't say, geopolitical crises. Not that I'm saying, hey, they don't matter, turn off the news, Venezuela being the most recent example, but they don't tend to have long-lasting, in and of themselves, long-lasting impact on the market. Although I had a funny retort that I got on social media in response to the report that we recently just wrote just on Monday that had a table in it about geopolitical crises in the past that had a military flavor to them and what the subsequent market action was. And someone came back and said, yeah, but you're conveniently not focusing on 2001 Afghanistan, and the market was still down, 25% a year later. And I thought, there was maybe something else very market related going on in '01, like the bursting of the internet bubble and a 2.5-year bear market that I don't think you could thread directly to Afghanistan, but okay. So
that's the internet for you.
That's the internet for you. That's social media for you. So I think those would be things that certainly could happen that would cause me to say, okay, we may be in rougher sailing here. So I have a pretty constructive view without trying to time the market. But as I already mentioned, with a different flavor to the market, more opportunity, whether it's down the cap spectrum into other sectors of the market continued opportunities outside the U.S. And for now, nothing has upset that. Of course, we're only 7 days into the
Of course.
year.
Yeah. So, and I should note, we're recording on January 7th. This will publish on January 14th. So a whole week, a lot of things can change in the world.
A lot of things can change.
I would hope that the world doesn't change too much.
I may sound like a complete idiot by the time this airs here.
We're not going to have any questions that really timestamp you poorly. But I will say, anytime I have clients or family or friends who are asking about certain headlines, I always ask them, well, how do you think that's going to impact earnings? Like, is that going to change the amount of Coca-Cola sold or the amount of pharmaceuticals sold? And earnings really is what over the long term is going to drive price. There's some fluctuation there, but a lot of people are paying attention to a number of things. You actually mentioned the Fed. That's something I want to touch on because I get a lot of listener questions. A rate cut is expected. A new Fed chair is expected. Talk to us a little bit about your thoughts around all things Federal Reserve right now.
Yeah, so I think the needle almost literally moves on a day-to-day basis in terms of expectations for what the Fed will do next. Market-based expectations can be calculated. Probably the most popular tool that is used that is easily accessible if you know how to Google something is just the CME FedWatch tool. At any moment, it tells you what the probabilities are for the next meeting in terms of do they stay on hold, do they cut? But that's a moving target. And because the Fed is in data dependency mode, not to mention the fact that we had such a lack of data during the government shutdown, and we're just now starting to digest data that's coming in, those expectations are going to jump around. My guess is that the Fed is not as anxious to cut rates again here, in part due to still sticky inflation. And then, the recent labor market report that was healthier than expected. We have in between when you and I are having this conversation and when this will actually
we'll get the big report. Yeah.
There'll be a jobs report.
Yeah.
So I'm not going to try to forecast what
That's
what is
okay.
going to
Everybody
happen
forgives
there.
you for not predicting the future.
Thank you.
You're good.
But I think those will continue to be needle movers, and we have such a cacophony of Fed speakers now. That maybe is one of the most interesting things. So I've often joked that the Federal Open Market Committee sometimes can be called the Federal Open Mouth Committee. There's just been more support, not just under Jerome Powell, but even under Janet Yellen, and it started to some degree under Ben Bernanke, which is unlike under the Greenspan days, just providing freedom to members and Fed governors and regional Fed presidents to express their views, and so many more platforms that could be done with the internet and social media. But I think what's interesting about Fed policy in this backdrop is that there's not a common thread here. You're seeing it in the last several Fed meetings where you've had more dissents in both directions, where
Which
one
used
member
to be
says,
so unusual.
And I think it's going to be more usual. You look at the so-called dots plot. So every other Fed meeting, there's an updated summary of economic projections, every member's perspective on where the unemployment rate's going to be, where the GDP is going to be, where inflation is going to be, and where the Fed funds rate is going to be. The range of those expectations is wider than it typically is. And I think that is going to continue. So it's going to be a little bit trickier to try to gauge, okay, what's the Fed's next move? Because it's not just a function of the data, but a variety of opinions. In terms of who is picked as the next Fed chair, lots of changes happen there. As we speak, it's still seen as likely it's going to be one of the Kevins. But, needless to say that the president is mercurial. So he can change his mind, but that seems to be where we're headed. I'm less concerned than I was maybe 6, 7 months ago about direct, imminent, and legitimate threats to the independence of the Federal Reserve. Prior to having some of those concerns eased, I will tell you that when I often get like an open-ended question from clients saying, what keeps you up at night? What do you think is a big risk? And my answer was typically any meaningful threat to the independence of the world's most powerful central bank.
And what changed your mind?
Well, it's not so much that it changed my mind. It's just I maybe notched it down as sort of this imminent threat. A couple of things. Stephen Myron being put on the Fed, and he became a dissenter in favor of easier policy, but he didn't sway anybody else. And in fact, I think to some degree, there may be members who might lean slightly toward bucking that just so as to say, look, we're independent. We make decisions based on what we think is right for the economy, based on our dual mandate, and not based on any kind of political influence. Then you had the Lisa Cook situation where there was an attempt to fire her that was stayed by the courts, and she continues to be a voting member. The fact that Kevin Warsh is still in the running, and full disclosure, I've known Kevin for 20 some odd years. And maybe the market's view that he's an independent thinker and operator and wouldn't be the type to battle political pressure. But I think it's the dissents and the wide range of views that really reinforces what I always remind people of. The C in FOMC is committee, not chair. So even if the administration was able to put in sort of a yes man, that there are other voices that have the voting lever. And so I don't want to say, don't worry about it at all, not a
Sure.
risk, just less acute a risk than it was, call it midsummer last year.
Well, that's certainly one of the things that comes up in client conversations from time to time. Maybe I'll zoom out and hit a couple of those other things that aren't necessarily specific to right this moment in time. They can be, but they feel like they've come up throughout my career quite a bit. One being the US dollar. I think people get concerned about its position as the global reserve currency. What are your thoughts here? What do you think people miss in this conversation?
I'm not worried about the dollar losing its reserve currency status, in large part because there's no replacement for it. People at times will say, well, what about the euro, given that it represents as a block, a bigger economic block than the United States is. The problem is that it's a single currency, but it's 17 individual countries, all with different fiscal policies and all with individual bond markets. So it's just not feasible that the euro could represent a replacement for the dollar as the world's reserve currency. It's not the Chinese yuan. It's not truly convertible. It represents a single digit percent of world trade. I don't get comments anymore from people saying they think Bitcoin is the next reserve currency, so I don't even have to address that piece of it
That's nice.
anymore. I do think, though, that we are eventually probably going to think of there being sort of multiple reserve currencies. There is more trade being done in local currency terms. Some of that is actually a function of technology and the ability to do sort of currency translations on the fly, plus different trading blocks that have formed in response to not just sort of tariff issues or geopolitical issues, but even back to the COVID days, in given the supply chain problems and the desire to have more diversified supply chains and more diversified means by which transactions happen. So I think the notion of maybe multiple reserve currencies down the road, I think, is viable. Another aspect that comes up with regard to the dollar and the view that it would lose its reserve status is diversification away from the dollar. That's not a new story. That's an ongoing story. China's central bank, the PBOC, has been diversifying away from what had been such a dominant holding of dollar-based securities, specifically treasuries. But that's a story that's more than 10 years old. And that's a story that will continue to unfold over time. This notion that China is going to wake up one day, figuratively, and just decide to dump all their dollar-denominated securities, I guess it could happen, but they would be aiming the gun squarely at their own economic foot and causing at least as much damage to themselves as they would to us. So I think that diversification story is more of a slow process. In the meantime, there's just still a lot of demand. Most of global trade is still conducted in dollars on one side of the transaction or another. Those dollars have to be reinvested in something short term at times and safe and liquid, and there's just no replacement. So that brings another thread into this. But I don't worry about the U.S. defaulting on its debt. I don't worry about the dollar losing its reserve currency status. I don't worry about massive dumping. But it's in the context of an environment where things are changing as it relates to the dominance of the dollar.
I could not agree more. I find myself covering this topic in my solo episodes at least once a year. And so if you're listening and you want to find the latest, it was episode 213. So that was back in July 2025, talking about the US dollar, talking about the debt, I think the week before that. And since you mentioned you're not worried about the US debt, why don't you give us a little bit more color?
I am worried about debt.
Sorry,
I'm not worried about a debt default.
Okay, fair enough. Because we can always pay our bills.
Yeah.
We may not choose to. I guess there's
Right.
been a couple times we've almost said, but I mean, give us some color there on if you're an investor listening and you're worried about the U.S. national debt, what would you say to that?
Well, I think probably the most important implication of a high and rising burden of debt, aside from the increase in cost of servicing that debt, is that in and of itself, it acts as a bit of a wet blanket on growth. And that's not a recent phenomenon, and that's not just a US phenomenon. That's everywhere throughout time. If you look at statistics historically and you look at different zones of not just the level of debt, but the growth rate in debt and the trajectory of deficits, and you look at implications for everything from GDP growth to job growth to productivity to inflation, it actually tends to act as a suppressant on growth. So that's not a new phenomenon, and that's a global phenomenon. So that's going to be with us. The cost of servicing debt piece of it is probably why this whole subject has become more spotlighted. As many remember a year ago or so, and I have to say now back to 2024, because saying last year is now 2025.
Yeah, we've moved past
I know
that.
we have to change the mindset,
yes.
readjust. But in 2024 was the year where the cost of servicing our debt leapfrogged the cost of defending our country. And centuries worth of books have been written about the fall of empires, starting when the cost of servicing your debt exceeds the cost of defending your country. And so I'm not suggesting that that was some, trigger for impending doom for the US, but that might be one of the reasons why more attention was given to this issue. The problem is that neither side of the aisle actually cares about this. They can say they care about it, but they don't do anything about it. There's really not any honest conversations about how to try to tackle this in Washington. And that may be because even though I think the investor class cares deeply about this subject, I get asked about this all the time. If I don't bring it up in formal remarks, it's the number one hand that goes up. Talk about the deficit and debt. And I think the average constituent maybe cares about it in the abstract. It's hard for them to grasp what $38 trillion in debt is, but they don't vote based on it because very few people are going to be willing to vote for either a significant cut in whether it's entitlements or spending that benefits them or a significant increases in taxes. That said, given where we are right now, you could raise taxes on everything and everybody to 100%, and you could cut spending to zero. Government doesn't spend money on anything. You still don't really tackle this problem without touching entitlements. But there's just not political will to do that. So we'll continue to sort of chip away at the problem. Speaking of chipping away at the problem, the real solution to this problem, and it's not draconian, is to somehow get to the point where the growth rate in debt is lower than the growth rate in the economy, because then you start to mathematically chip away at the problem. We're not there yet, and I don't have a tremendous amount of confidence that we're going to get there anytime soon.
And does the more indebted you get make it that much harder to grow faster?
Absolutely.
Yeah.
No question. It's a crowding out effect. It crowds out more productive uses of that money.
Well, I agree with you. The average voter doesn't care about the issues because the last presidential election we had didn't really talk about it. And so until it becomes a real platform issue of a presidential election,
right.
I would agree with you, probably doesn't get addressed because all the things that make it better are going to be very unpopular. But it's Very complicated. And I appreciate, I think, as you mentioned, a lot of people ask the question. It's something I feel like I address on an annual basis.
Mhm.
I'll ask the question. I usually ask this of fixed income people, and I hear you a lot say that you're a tourist in the fixed income
Yes, I
space.
am.
So I will
I'm
ask
jealous,
cautiously.
though, of the people who live in the fixed income space.
It actually is
Fixed
really
income market
interesting.
seems more rational.
Yeah, I mean, it's more than just math over there. It's very interesting stuff. But, I would agree with you. A default is not really possible and or likely. But the question I'm usually asked is, if I think there's going to be a default, what do I invest in? A lot of portfolio managers I talk to will say long-term treasuries, which seems very counterintuitive because there's a flight to safety and there's nowhere else to run. Do you care to share an opinion on what you might say would win? Obviously, recognizing this is kind of a crazy question to begin with.
I think you would maybe ironically see that flight to safety, and and I'm now parroting my colleague Kathy Jones, who is our chief
Sure.
fixed income strategist, and she allows me to just be a tourist in the fixed income market. But I think yeah, there is a risk, of course, of the so-called, my friend Ed Yardeni, the bond vigilantes, uh, coming in and sort of trying to send a message through the bond market, maybe to politicians, that enough is enough. There have been a lot of fears about that over the last couple of years that obviously haven't come to fruition. So, some of the extremes you're talking about, like a default, we just don't think it's going to happen.
Right.
So it's hard then to say, well, if it did, would there be that? I think it would be kind of Armageddon in a
I
lot of
couldn't
ways.
agree more. It's like more of a thought exercise than a real prediction of happening. And it's sort of why I won't put you on the spot on it too much, because it's just a silly kind of place to be where you should never, no one would never say never. There's like
Well,
infinite
right.
possibilities. But if you're worried about runaway inflation, which is what then people will respond to me saying, okay, we're not going to default, but we'll have a lot of inflation. Well, historically, stocks are a great place to be long term when you're
In
in
fact,
inflation. And
over the long term, it's the only asset class that on a kind of, decade basis has outperformed inflation. A lot of people think, "Oh, gold is the ultimate inflation hedge." But gold has become more of a sort of geopolitical concerns about, currency debasement
like an
and
expectations trading tool,
yeah.
right?
So
Yeah.
I interestingly, you asked about if there was some draconian situation of default. I think concerns about the debt and deficit and the status of the dollar are part of the reason why precious metals have been on a tear. So we're not really just talking about prospectively, what if we face a worst case scenario here? I think some of that's embedded in the rationale behind why gold and other precious metals have been on a tear.
Well, I appreciate you letting me take you into crazy town for at least a brief moment. But like, why don't we finish out here, zooming way back out to the long-term perspective, which you obviously have in your writing. You talk about very timely things, but almost every one of your pieces ends with a paragraph or two that keeps that long-term perspective. So maybe you could
Yeah.
share a little bit of what the benefit of maintaining that long-term perspective is, both for someone who is interested in the type of information you are providing, or just someone who's a market watcher in general.
Yeah. Let me answer that at first by putting in the context of investing versus gambling. There's such a new focus these days by certain cohorts on gambling, short-term trading, the retail trader, distinct from the individual investor, sort of born out of the pandemic, and the rise of the platforms, the betting platforms, and really this melding by certain cohorts of investing into gambling. And I think it's a really important time to differentiate between the two. And one easy way to think about the difference is investing is about owning. You are owning companies, you're owning securities. It's ownership. Gambling is about hoping. And there's a big difference between those two. We all know the history of, the longer the time horizon, the better the returns over the last 20, 25 years. The Dalbar kind of studies show that as time horizons have gotten shorter and shorter, performance has also suffered commensurately. So there's reams of data showing that. When you have more of a gambling mentality and time horizons get shorter and shorter, it has people morphing to a get in, get out approach to investing. And I always like to say, neither get in nor get out is an investing strategy. That is actually gambling on not just one moment in time, but two moments in time. There's this misperception that the key to success is knowing what the market is going to do. It is not what we know that matters, meaning about the future, what the market's going to do, what the next turn in the economy is going to be. What matters is what we do along the way. And that goes to the disciplines. Frankly, the stuff that maybe is boring to talk about on a podcast or on financial TV, the beautiful disciplines of periodic rebalancing and diversification of growth within asset classes, but that's what matters. The last thing I'll say is, and I pose this question quite a bit when I'm in front of an audience, and I'll say, I love doing jigsaw puzzles, and that's the truth. I love jigsaw puzzles. It's great for my mind. I even sometimes do them if I'm on a conference call because it doesn't tax your mind. It actually kind of keeps me focused, and I can listen better. But I always say, what's the most important? I always ask the question, what's the most important piece of a jigsaw puzzle? And hands go up and they'll say the obvious, the corners or the final piece, the edge pieces. Pause for effect. Then I say, no, it's the picture on the box. Try doing a 1,500 piece jigsaw puzzle without looking at the picture on the box. That represents the plan. You need to have a plan. And then the pieces fall together. Trying to wing it and taking a get in, get out approach, I think that's what trips people up.
I'm in the middle of writing a book. I'm not gonna lie, that's probably gonna end up in there somewhere.
Well,
it's brilliant, but you'll get credit, I assure you.
Well, thank you.
One of my colleagues, Rainey Verby, and I do jigsaw puzzles on conference calls all the time, so we can associate.
I have an app for it, and I'm type A, and I think I have some version of adult ADD. And if I'm just on a conference call, not on camera, it's just human nature for me to check email and get distracted with something. And if I sit and do a jigsaw puzzle and I'm on a conference call or I'm listening to a podcast, I listen much better. So it's just a trick that I do just based on my brain makeup.
I love it. I do that too. I feel more normal now. And I was going to end with a different question, but based on sort of where you just went there with the plan, and given what your role is and how plugged in you are to the overall market, do you get financial assistance? Maybe tell us a little bit about
Sure.
how you invest your own money. If you get assistance, would love to hear about that. Anything you're willing to share, I think the audience would benefit
I
from.
absolutely get assistance, in part because I really want to focus on my job on behalf of investors. I don't so-called manage my own money. I'm not picking funds. I'm not picking stocks. Use an all-inclusive approach that involves both money management, but also estate planning and tax planning and, wills. So it's a nice collective way to think about everything together, both through Schwab and firms that are on our platform. So I certainly utilize what we have to offer. But I'm not picking stocks on my own. I was a portfolio manager for my first 15 years in this business. I didn't love it. I didn't love picking stocks. I'm much more interested in big picture, top down. So those day-to-day investment decisions, especially as it relates to securities, I let others do that for me.
Yeah, I do too. I have a financial advisor.
Mhm.
I mean, I'm a CFP, CFA, and while I know enough to be dangerous, now that I'm not client facing anymore, I'm certainly not of the quality of our advisors at this point, but it's just great
And I
to
collaborate with them, and we
Sure.
talk about big picture, and we talk about asset allocation. I'm not just twiddling my thumbs and saying, "Okay, let me know every quarter how things are going." So I'm very engaged participant, but I'm not so-called running my
You're
own
not
money
pushing
on
the
it.
button. No,
Right.
you got better things to do with your time, as I suspect a lot of people do. I guess let me just ask you then one last question since
Sure.
we have the time. You have had such an interesting career. I mentioned a number of times, I've followed you really closely since the financial crisis, but in following you, I've heard a lot about your experiences prior to Charles Schwab. I'm kind of curious, is the way that you view the market. Sentiment is something I'd written down early on, was something
Yes.
that you talk about probably more than most people that I
Yep.
follow. You also are a big proponent of earnings in general. Sometimes I'll ask people in your role, which if you can only get one, you're going to take the jobs report or the earnings. And I suspect you'd say earnings will be the quick question. Yes. Yeah. Has anything changed for you materially in the past 10 years or past 20 years, or just in your time at Schwab, in how you view the market, and also maybe what's stayed the same?
Yeah. So let me adjust your question or pretend like you said in the last 5 years, if that's okay,
Sure.
or the last 6 years. I think this kind of post-COVID era, which, as I already touched on, brought about the rise in power of the retail trader. It has changed the sentiment backdrop in a number of ways. There's a wider array of sentiment. You don't tend to get these sort of monolithic extremes, either of optimism or pessimism. Big differences depending on what cohort you're surveying or observing. There's also, maybe somewhat as a result, there are bigger gaps between what I call attitudinal measures of sentiment. So, survey type data. The most common one that people watch and has been around since the mid 80s is AAII, American Association of Individual Investors. They do their weekly survey. Are you bullish? Are you bearish? Are you neutral? That's purely an attitudinal. It's just asking people, how do you feel? Then there's the behavioral measures. Traditional ones, even AAI does a survey of what's the actual equity exposure of their members. So within that one survey, you get, what are they saying? What are they doing? And in these last 5 to 6 years, you can see a huge spread between those two. Other behavioral measures are things like fund flows, but you've had to morph the thinking there away from what were mutual fund flows back in the day to now, ETF flows. But other behavioral measures in the options market, more than just say the put call ratio, which Marty Zweig actually invented. So I've really had to think more broadly and more creatively about sentiment, because it's just not the pendulum swinging from one direction to another. So I think that's the most notable change associated with a factor that I think still is so important. And one of the reasons why I said I'm jealous of people on the fixed income side of things, to a large degree, the bond market is about math. To a very large degree, the stock market is about psychology. And I think math is obviously more concrete, a little bit easier to try to figure out. Psychology, man, that's the tough one, but it's the fascinating part of it.
Well, there's also more than half of the bond market that's not profit maximizing. So you really get to do some fun stuff when stock market's pretty darn efficient. I'm not going to say it's perfect, but
it is.
Liz Ann, this has been tremendously great for
thank
me.
you.
I really appreciate your time here. I'm going to link to a lot of the places people can find your work in the show notes. But for those of you watching, where should people look for you?
Sure. So all of our research at Schwab is on the public site of schwab.com. A lot of people don't realize that. You don't have to be a Schwab client. If you know how to, type in schwab.com, there's a Learn tab. All of our research, everything that I put together, and all my colleagues within Schwab Center for Financial Research, it's all out there in the public domain. An efficient and regular day-to-day, minute-to-minute way to get information is I'm very active on what I still call Twitter.
Me too. I still call it Twitter.
I still call it Twitter.
Yeah.
I have had, this is a public service announcement here, I have had an unbelievable rash of imposters, thousands of imposters, not just on Twitter, where I'm an active participant, less so on LinkedIn, just because it's a different kind of beast. But I've got handles, multiple, dozens of handles on Threads, on Instagram, on Facebook, on Blue Sky. They're all scams. They're all imposters. There's a money grab that happens into a WhatsApp. Typically, it's a claim that I have a private stock picking club or I have a crypto picking club. They're increasingly using AI generated videos that are actually, it's my face, it's my
that's
voice.
Scary.
But what I'm saying is nothing I have ever said. So it's a great way I react to every economic report. I post probably 20 posts and charts and data every single morning. Plus I post everything that I've written. So it is one-stop shopping, just make sure you're following the real me. It's just
Everyone, Liz Ann is not going to directly message you. That's the real takeaway.
I'm not going to directly message you. I'm not looking for money. I don't have a private stock picking club. If you see funky characters in my handle, it's not me. It's just at LIZANNSONDERS. That's the only one that's me. So that's a great way to get everything. Just make sure you're following the actual me.
Definitely one of the best follows. I asked you when we first met in person in the fall, like, is that really you putting all those charts out every day? And
now,
you said yes.
I don't generate the charts.
You have the ideas though, and then you publish. I was surprised no one publishes.
My team, Kevin Gordon and Adrian Beata, they put those charts together. I'd be crayons and construction paper, which wouldn't be terribly interesting. But
my team says I'm not allowed to use Excel anymore. So if that makes you feel better.
Okay, it makes me feel better.
Everybody definitely go do that. I will link to the accurate Twitter/X social media account, as well as all the Schwab resources that was mentioned. Liz Ann, again, thank you so much for joining me here today. And for everybody watching on YouTube, make sure to subscribe, like, do all the things that help people find more great guests like Liz Ann. And if you're watching us on Cheddar News, head over to thelongterminvestor.com. Liz Ann, thanks again for joining me.
My pleasure. Thanks for having me. Absolutely loved our conversation. Such a treat.